Now we come to the step 4. So at the acquisition day, we have to measure the net assets of the acquiree at the day of acquisition at fair value. So at the acquisition day, we can determine the net assets of the acquiree. So if 7-Eleven come to acquire Circle K, we have to measure the net assets of Circle K. So it includes the identifiable tangible assets of Circle K, identifiable intangible assets. It measures also the liability because we are talking about the assets and liability, net asset. When we consider the consideration, if you can still remember, we consider the contingent consideration. Therefore, at the net asset side, we consider also the contingent liability. Even if the acquiree did not recognize this contingent liability, we may have to recognize it on the day of acquisition as a process of business combination. So everything should be measured at fair value at the day of acquisition. So if this is an asset other than the intangible asset, we will measure it at the fair value at the day of acquisition. We'll recognize it if it is probable and if the fair value can be measured reliably. So for liability other than the contingent liability, again we pass using the usual recognition criteria, which is probable, and also the fair value can be measured reliably. But for contingent liability and for intangible assets, we waive the probability criteria because contingent liability, by definition, cannot be probable. If it is probable, it is already a liability. So we waive the probability criteria. This waiver of probability criteria is just for the business combination. So therefore, if this is an intangible asset, in the financial statement of the acquiree, it may not be able to recognize it, but on business combination, we may recognize. So some items like the brand name, customer list, in-process research and development project, which were ineligible for recognition in the acquiree's own book, may be recognized on business combination. You may find it in the consolidated financial statements. So therefore, under the financial reporting number 3, once it meets the definition of an intangible asset, and once the fair value can be measured reliably, we will recognize it. We don't need it to be probable. So what is intangible asset? We must have studied Hong Kong Accounting Standard number 38. So intangible asset is defined as the identifiable non-monetary assets without physical substance. So the question is, why in a business combination we can allow the recognition of such intangible assets? So say for example, for brand name, we understand that internally generated brand name cannot be recognized in the individual financial statements. Customer list, every company has got a customer list. You will not recognize it as an intangible asset in your own financial statements. And for research and development, if you can still remember how we study intangible assets, research and development, so every expenditures on the research phase never can be capitalized. For the development phase, still we have to fulfill all the 6 criteria. Something like you have got the intention to compete, resources to compete, there's a market, technically it is feasible, and then there's a market so that you can use or sell it, and then finally the fair value or cost can be measured reliably. You must fulfill all these 6 criteria so that you can recognize development costs in your financial statement as an intangible asset. But on business combination, we don't require this. We don't require this at all. Why? Say for example, if I pay $100 to acquire another business, and I find that the net assets of that business that they have recognized in their financial statement is only $60. If that is the case, goodwill is what I pay minus what I get. Therefore, goodwill can be 40,000. So goodwill will be 40,000 because goodwill is what I pay minus what I get. But I can ask you, what is goodwill? What is goodwill? Goodwill simply means something I don't know. right? I pay $100 to acquire that business, but actually that business net assets worth only $60. I cannot say that I'm stupid, so that's why I say I pay 100 because there must be something good in that business. I call it goodwill. Therefore, this $40 is goodwill. But actually, I cannot tell what for that $40 is. Instead of classifying everything as goodwill, I can say that why I pay 100 because I like particularly the brand name of that business. So that's why I pay 10,000 for the brand name of that business, even though in the financial statement of that business they don't capitalize it, but I pay 10,000 because I like that brand name. Also, I pay 10,000 because I know the relationship of the suppliers is very good for that company. I want to get that supply relationship, and therefore I pay 10,000 for that supply relationship. In addition, I want to get the customer list of that company. I don't know their customer, but I want to know their customer. So that's why I acquire that business so that I can get their customer list. I can contact them. Therefore, I pay 10,000 for that customer list. So this brand name, supply relationship, and customer list is not found in the financial statement of the acquiree. I really pay money to acquire it. By telling the financial statement users that I pay 10,000 for the brand name, 10,000 for the supply relationship, and 10,000 for the customer list, actually the goodwill amount is only 10,000. So that's why the amount that I don't know why I pay for it is smaller. Only 10,000 is for goodwill. It's better to tell the financial statement users more information than telling the financial statement users that 40,000 is paid for goodwill. So what is for that 40,000 paid for? Goodwill. What is goodwill? Right? But I tell the financial statement, I actually pay for the brand name, I actually pay for the supply relationship, and I actually pay for the customer list. This is one of the major reasons why in a business combination, we allow the capitalization of this intangible asset. Another reason is actually in a business combination, there's a transaction. I really pay money to acquire it. Actually, internally generated brand name cannot be capitalized. Internally generated customer list cannot be capitalized. Yeah, but if I really have a transaction, I really pay to acquire the brand name, it can be capitalized. I really pay to acquire a customer list, it can be capitalized as intangible assets. So in a business combination, there exists a transaction. Therefore, there's an objective way to measure the fair value, and therefore we allow this to be capitalized on business combination. Therefore, in a business combination, you will recognize some intangible assets that you cannot capitalize in the individual financial statements. So that's why you may have got household brand name. Once you can find the market value, you capitalize it. You may have a customer list. Once you can find the fair value, you may capitalize it. For customer relationship, if you can really find the fair value at the day of acquisition, you can capitalize it. But in this case, because we believe that it will not have any value once the ownership and management change, therefore you cannot measure the fair value reliably, and therefore we will not recognize. Similarly, for contingent liability, we will recognize it on business combination. As I've said before, we recognize the contingent consideration, therefore we recognize also the contingent liability. Even though it is not probable, we will recognize. So therefore, in a business combination, you may recognize the contingent liability of the acquiree as long as you can find the fair value. So in this case, you can find from the notes to the financial statements or even from the minutes that there may be some contingent liability. And once you can find the fair value, you will capitalize. So for this case A, you cannot find the fair value, we don't capitalize. For case B, you find the fair value, so you may capitalize it at fair value at the day of acquisition. Something also related to the net assets acquired. So we measure assets and liability of the acquiree at the day of acquisition. So therefore, if this is a future obligation, we don't recognize. We only recognize a liability at the day of acquisition. In usual case, restructuring provision is something in future. Say for example, after I acquire 7-Eleven, I may fire some of the staff, I may close some of the divisions, but this will happen only after the day of acquisition. Therefore, this will be the future costs. It is not a liability at the day of acquisition. Usually, we will not recognize it at the day of acquisition. But it's a very special case. Hong Kong AS 37 specifies that we may have to recognize a provision for restructuring if there's a constructive obligation. Constructive obligation. So when will we have a constructive obligation to restructure? First, you must have a detailed formal plan for the restructuring. So you know what divisions you are going to close, who you are going to fire, etc. Second, it must raise a valid expectation in those affected that I will carry out the restructuring. So as I've said before, if I have acquired 7-Eleven, I may close down some of the divisions. But if I really acquire 7-Eleven before the day of acquisition, I may have to negotiate with the labor union or some of the staff in the 7-Eleven saying that I may have to close down some of the division, I may have to fire some of the staff. If I start to implement that plan, or if I have already announced the main features to those affected by it at the acquisition day, it will raise a valid expectation that I will really carry out the restructuring. If this is the case, this is a constructive obligation. So two elements, there must be a detailed formal plan, and also it raises a valid expectation. So once we have a constructive obligation to restructuring, we may recognize this restructuring costs as a liability at the day of acquisition. But this is a very special case. In usual case, restructuring costs will be future costs that we are not going to recognize. Only if there's a constructive obligation at the day of acquisition, then we recognize it as a liability at the day of acquisition.